They didn't attack the market in public. They did it quietly, overnight, hoping fear would do the rest. But this time, something went wrong. They always choose the same moment. When most of the world is asleep, when headlines are quiet, phones are face down, and attention is low. That's when the real moves happen. Last night was no different. While New York was dark and Europe was just waking up, the financial gatekeepers pulled a lever they've relied on for decades. Not by increasing supply, not by announcing a discovery, not by fixing the underlying problem. They changed the rules. If you woke up today, opened your chart, and saw red, if silver suddenly dipped and that familiar knot tightened in your stomach, pause. Take a breath. What you're seeing isn't a collapse, it's pressure. And pressure only gets applied when something refuses to break. Overnight, the exchange responsible for pricing silver futures raised margin requirements sharply. In simple terms, they made it dramatically more expensive to hold silver contracts, roughly 50% more costly than just one day earlier. This wasn't accidental. It was strategic. The goal was liquidation. The goal was panic. The goal was to force leveraged traders out before the weekend. But here's the part they didn't expect. It failed. In past cycles, this exact maneuver crushed the market. In 1980, it triggered a collapse of nearly half the price. In 2011, it wiped out over 30% in a matter of days. This time, the price dipped, steadied, and refused to fall apart. That single fact should send a chill through every institution betting against physical silver. Today, we're going to break down exactly what happened. We'll explain what a margin hike really is, why it's usually devastating, and why it didn't work this time. We'll compare this moment to the historical playbook, and then we'll go deeper into the real flows that never appear on a screen. Because what happened today wasn't weakness. It was confirmation. To understand why the price turned red, you first have to understand how silver is actually priced. Most people imagine a simple exchange, a buyer, a seller, a coin. That's not reality. The price is set almost entirely by futures contracts traded on leveraged exchanges. These contracts allow massive exposure with very little upfront cash. Until yesterday, controlling 5,000 ounces of silver didn't require hundreds of thousands of dollars. It required a margin deposit of roughly 12,000. That's leverage on a scale that magnifies both gains and losses. It's also the mechanism the exchange controls. When margins rise, leverage dies. Here's how it plays out in real terms. Imagine a large fund holding hundreds or thousands of contracts. Overnight, the exchange announces that every single contract now requires significantly more cash to maintain. Millions of dollars must be posted immediately, often within hours. If that money can't be wired in time, positions are forcibly sold by the exchange's system. Not because the holder wants to sell, not because fundamentals changed, but because the rules did. This forced selling creates artificial downward pressure. It's mechanical, not emotional. And when others see the price drop, fear spreads. Selling begets more selling. That cascade is the weapon. This tactic has a name, and traders know it well: the margin nuke. In 2011, it worked perfectly. Margins were raised repeatedly in rapid succession. The cost of holding silver exploded. Speculative demand evaporated. The price collapsed from euphoric highs and stayed suppressed for years. The banks assumed they could run the same script again, but they misread the cast. The silver buyers of today are not the silver buyers of 2011. Back then, the rally was built on paper, hedge funds, leveraged bets, and derivative exposure. Physical supply was plentiful. Vaults were full. When the paper demand vanished, there was nothing underneath to support the price. Today is the opposite. Industrial users don't buy on margin. Governments don't post leverage. Corporations don't speculate, they secure supply. When Tesla needs silver, it pays in full. When a nation stockpiles metal, there is no margin call. So when the exchange raised margins, only one group felt pain: paper speculators. The physical buyers didn't flinch. That's why the dip was shallow. That's why it was bought instantly. And that's why the market didn't break. To see why this matters, we need to revisit history. In early May 2011, silver was surging. Sentiment was euphoric. Headlines were loud. Then, quietly, margins were raised again and again, 5 times in just over a week. Each hike forced more selling. Each drop triggered more fear. Eventually, the rally collapsed under its own leverage. The institutions are counting on your memory of that moment. They want you to see red today and assume the same outcome is inevitable. They're banking on reflex. But look closer. In 2011, silver fell over 10% in a single session. Today's move barely registers by comparison. Instead of panic, we saw consolidation. Instead of collapse, we saw absorption. The reason is simple: physical scarcity. The world is facing a massive silver deficit. Vault inventories are depleted. Refining capacity is strained. Demand from energy, electronics, and infrastructure continues to grow, and no amount of paper regulation creates new metal. You cannot fix a physical shortage with financial rules. And today, the market proved it. What the margin hike actually accomplished was not destruction. It was cleansing. It flushed out over-leveraged positions and transferred ownership to entities that don't sell on dips. This is known as a bear trap. Prices are pushed down deliberately to trigger fear-driven selling. Retail traders exit, shorts pile in, but beneath the surface, stronger buyers absorb everything. Ask yourself, who was buying when silver dipped today? It wasn't panicked retail. It was algorithms tied to industrial procurement. It was corporate buyers with standing orders. It was institutions that don't trade headlines, they trade necessity. These buyers operate in markets you don't see, over-the-counter deals. Private allocations, long-term supply agreements. When prices dip below key levels, automatic purchases are triggered, not for speculation, but for consumption. Once silver enters that pipeline, it never comes back. That's why the floor keeps rising. Every forced dip drains available supply faster. Every manipulation accelerates the transfer from weak hands to permanent holders. The very tool designed to suppress price is now strengthening it. This is why the timing matters. Why Friday? Because weekends terrify the paper market. When Western exchanges close, price control weakens. Asia opens. Physical demand asserts itself. If silver closes the week strong, it sends a global signal that control is slipping. That's why the institutions wanted a red candle, a long wick, something to frame weakness. But here's the irony. By suppressing price ahead of the weekend, they're effectively offering a discount to the strongest buyers on earth, buyers who don't care about margin hikes and don't answer to Western exchanges. If Asia interprets today's move correctly as a failed attempt to crash price, the response could be aggressive. This brings us to the deeper divergence. On screens, price appears managed. But behind the scenes, something else is happening entirely. Industrial demand is relentless. Standing orders sit below the market, absorbing every dip. This invisible demand acts like a concrete floor. That's why price bounced repeatedly at the same levels today. Not coincidence, structure. So what happens next? The regulators are running out of tools. They can attempt position limits. They can restrict buying. They can even force liquidation, only trading. But each step further damages the credibility of the exchange and accelerates the decoupling between paper price and physical reality. If paper silver trades far below physical value, supply simply exits the system. Miners sell elsewhere. Buyers bypass the exchange. Control is lost. That's the paradox. If they intervene too little, price rises. If they intervene too much, the market breaks. Either way, scarcity wins. Which brings us to the real question, why are you holding silver? Is it to trade fluctuations? Or is it to own something real in a system built on promises? Today wasn't about price. It was about proof. The paper system tested physical demand and failed. 1 ounce remains 1 ounce. And that ounce is becoming harder to replace, harder to source, and harder to control. The margin hike was meant to shake conviction, to force doubt, to separate you from your position. Did it work? If you panicked, that's what they wanted. If you understood what you were seeing, you recognized a discount. Looking ahead, the setup is dangerous for shorts. Positions added today are already underwater. Over the weekend, physical shortages won't pause. News won't stop. Demand won't wait. When markets reopen, pressure returns, and trapped positions add fuel. The path higher didn't end today. It clarified. They fired their strongest weapon, and it barely left a mark. The rules did change, just not in their favor. Hold steady. Ignore the noise. Physical reality always wins.